The next guest has his hands in various segments of the real estate market, including construction and property management. He says a freeze is ahead for housing. He also says there's one area that's going to hold up better than others. That's the multifamily market. For more, let's bring in Patrick Carroll. He is founder and CEO of Carroll, a real estate investment firm with more than $8 billion in assets. Patrick, why multifamily? Because I wonder, have investors gotten so involved in multifamily that they could pull back and affect the market?
Yeah, I mean, look, multifamily is an amazingly resilient asset class. I mean, when the economy is expanding, people move out of their parents' home, people relocate and they rent apartments. When the economy is slowing down and we're going into a recession, people pull back the amount of money they're spending. So they look for a cheaper alternative and tend to rent apartments. So historically, it's been a great asset class. There's definitely a freeze going on in the market right now. I mean, this was a market that had record transactions, the multifamily market, for the past few years. And right now, it's all about frozen. And it's yes, go ahead.
I understand the renter demand for multifamily, but what about the amount that investors are going to be willing to pay to own that multifamily unit, right? I mean, as interest rates rise, as perhaps the available capital shrinks a bit, is that going to affect the market?
Absolutely. I mean, we're seeing price declines in asset sales. I mean, 10 to 15% a minimum. We closed 2 properties last week, and there was at least a 10 to 15% discount applied. And so, yeah, right now it's very hard for investors and lenders to project where interest rates are going and where cap rates are going. And cap rates drive the value. So if you can't estimate the cap rate, it's very hard to estimate the value you should be paying.
So as an investor, what do you do in this environment then? I mean, I guess it's helpful to you if you got a bunch of dry powder cash to buy properties, though, hey, multifamily can be pretty expensive. Do you put that to work in certain segments of the multifamily market when you see prices coming down like that?
Well, we do. We just closed on our last fund. It's a multifamily investment fund. So we're actively deploying capital. We look at, any pullback in pricing is a good thing. We're, long-term investors for the most part, and we're long-term believers in the Sun Belt. We've been buying properties in the Sun Belt since 2011. We saw this trend coming. We're still, extremely bullish on these markets and believe they've got a long way to run. So, yeah, any pullback in pricing, we're an established company. We still can get debt. Unfortunately, a lot of the newer players can't, but we view this as an opportunity to grow.
So if we do end up going into a recession of some significance and there's a loosening in the labor market, if people start getting laid off, I imagine that affects the housing market eventually as well, right? Because if people can't afford to pay as much rent, if there are more vacancies, rents are going to have to come down. But that's several months off at least.
I hope so. I mean, look, it seems like everything's softening. So, to think there will be some type of softening in rents is a pretty safe bet. Now, I don't think you'll see a massive correction just because of supply and demand. I mean, you have more people moving to the Sun Belt than we do have, affordable housing available. So it's really kept occupancies, at record highs. It's kept rents going up. And, going into a recession, you may see a little mitigation of that, but I still think you'll see rent growth for the next 3 to 5 years in the market.
Okay, 3 to 5 years. We will see. Patrick Carroll, thank you.